Hi, welcome. It's Mary Ellen McGonagle with MEM Investment Research, and today I am going to be sharing with you ways that you can spot and then trade sector rotation that is oftentimes occurring in the market. Certainly now we are in a very treacherous period, so lots to cover. I'm going to go ahead and start. For those not familiar with my work, I do have quite a bit of experience both on and with Wall Street. I started my illustrious career on the trading floor of Goldman Sachs, but from there, and that was in fixed income. I did go on to a different large Wall Street firm, and I managed over 2 billion in assets during that period, and it was really a wonderful way to get tuned into precisely how the markets work. And that was, again, fixed income. But things got really exciting for me when I moved to the West Coast and joined William O'Neill and Company. For those not familiar, he's the founder of Investors Business Daily, all about helping investors get in front of these big winning stocks just as they take off. And I was working with top portfolio managers and analysts around the globe, teaching them that methodology, also advising them on the broader markets. And more recently, I do have my own investment research firm powered by Simpler Trading, top performing MEM Edge Report. I urge you to try it. I'll provide a link down below at the end here. And also, yes, I am a senior managing director at Simpler Trading. You can catch my work there as well. So let's jump right in. I'm going to begin by sharing with you one of the ways. Certainly for me, I did talk about working with professional money managers for many years. And it was during that period that I really tuned in to this concept of sector rotation in the equity markets. Oftentimes I would work with the larger firms, Fidelity, Merrill Lynch among them, and they would have what were called sector leaders. And it was this individual's role was to make sure that they had the proper weighting in certain sectors, and then from there, the best selected stock within that sector. So I'm sharing with you a view of Bill O'Neill's very top-selling book, How to Make Money in Stocks. And in that book, in the beginning of chapter 15, he talks about the majority of leading stocks, and these are going to be your big winners. They're usually in what are called leading industries. In fact, studies show that 37% of a stock's price movement is directly tied to the performance of the industry group that stock is a part of. And then another 12% is due to the strength in the overall sector. So therefore, roughly half of your stock's move is driven by the strength or weakness in your respective group for that stock. So really trying to give you that sense of how critical and how important it is that you get that sector allocation correct. And then we'll talk a little bit about industry groups from there. So what does drive this rotation, these money flows in and out of these various sectors? Well, in today's review, we're going to take a look at 2021. This way we can get a view of a full 12-month period. You will, in fact, see how big of a play sector rotation was for those individuals that outperformed the markets, and certainly professionals as well. I'm going to share with you the fact that the best performing sectors in 2021 were, in fact, the most volatile. We're also going to talk about some of the key metrics that were a backdrop in the volatility among these top performing sectors. So let's take a look here. Again, 2021, we are looking at a daily price chart of the S&P 500 in 2021. This is a January to December view. The S&P gained 27%. So certainly on the surface, that is an incredible return for the year. But what I'm pointing out to you here is just how many pullbacks there were. This is taking us back to January, then into March and so forth. Some of them were smaller. We had a larger pullback, certainly September into October, and then that year-end pullback. So it was not all smooth sailing there. From here, We can take a look at the NASDAQ composite. Again, a nice overall total return for that index. But let's take a look even more sharp in the way of pullbacks. This is February into March. We did get a correction and then another almost 9% pullback here in May, and then equally large September into October, and then the end of the year pullbacks. So again, giving you that that sense that things again were not smooth. It was volatile, as we are certainly experiencing in 2022 as well. So let's take a quick look here. This is a view of the overall sector performance for last year. And we can see energy, a very clear-cut winner, up 56%. And then real estate was up, stocks 38, financials and tech both up 34%. So for today's presentation, I'm going to be focusing on energy, financials, and technology. These sectors do have a heavier weighting in the broader markets. So let's take a look, because certainly, again, on the surface, this is a very top performing 56% move. But what I'm going to share with you here is a daily price chart. Again, this is taking us through 2021 and that nice 56% increase. But here again, that same daily price chart, and it was quite choppy. We can see in the beginning of the year, February into April, we had a nice 31% increase in energy. And we did have a 19% decline in that energy sector mid-year into third quarter. And then we ended the year here with a nice 28% increase in energy. So what I'm sharing with you also is why we did see one of several factors as a driver for this sector rotation. So in that year, in the beginning of the year, it was all about interest rates on the rise. And that in turn helped push these energy stocks higher. Again, there were other factors as well, but that interest rate backdrop was the primary driver. We did get a steep decline in interest rates into this period here, and energy stocks faltered. Likewise, again, later in the year, as rates rose, we did see energy on the rise. So let's go ahead. I did want to share with you a statistic. And in fact, rising interest rates are tied to inflation. We're certainly experiencing that now. And during that type of backdrop and that environment, the energy sector is the best performer in the S&P 500. This is going back over many market cycles and something to keep in mind. So let's take a look at a chart of EOG resources. I'm going to be sharing with you various stocks, and each one of them were selected. They are selected from my MEM Edge report, stocks that we selected. And in fact, I did want to mention this in the beginning. Last year, I did have 140 stocks that I selected for my MEM Edge report through the course of the year. And I did have a 75% success rate in those stocks that were selected. And of the 25% that were not winners, the loss percent average was 3%. So again, as we go through, you will see some of these stocks that were selected, and one of them is EOG Resources. And this is that latter period in the 2021 when we did see interest rates taking off. We did see this big move here in EOG. It was a nice of many stocks that were really taking advantage of that rotation taking place in the market. So here we are looking at energy again, and I am sharing with you again that concept as far as the interest rates being a driver. But let's take a look at another stock that was a big winner with my MEM Edge report, and that is Devon Energy. And in fact, this stock was one of the top 3 performers last year. And we added Devon Energy to our suggested holdings list the end of 2020, in November 2020, and we did hold on to it until this pullback here when the interest rate environment was impacting energy stocks. But let's take a look at why this was added back here. And this is a second factor that will often drive sector rotation. During this November 2020 period, Devon Energy reported their third quarter earnings. Now, the numbers were not positive. We were coming out of the pandemic, and the need for energy was not there as people were locked down. However, it was well above estimates. And so that earnings surprise caused Devon, as well as the energy group, to gap up and reverse a rather lengthy downtrend, entering into an uptrend. So from here, I did talk to you about financial stocks. They were up 34%. So what we during 2021, we're looking at a regional banking ETF, KRE, and this is taking us from 2021 through year end. And we can see, I talked about that 34% move in financials. They were primarily driven by these bank stocks, but let's take a closer look, and you will see that 34% gain for the year. Again, very volatile. We had this nice uptick here in the beginning of the year, and then likewise as the year proceeded, we saw bank stocks declining and then back up again. Again, interest rates were the primary driver for this move in banking stocks, highly sensitive to interest rates. Let's take a look at Comerica, CMA, another pick from my MEM Edge report. And what I wanted to share with you is the fact that this is another stock that we added prior to the beginning of 2021. Very similar phenom where the company did report earnings estimates. Again, they were not positive, but they were well above estimates, and management guided higher as it related to the outlook for CMA going into the new year. And this was another winner, 51% gainer. As we saw that response to interest rates taking place, we did exit the stock. Here's another larger money center bank. This is Bank of America. And again, that very similar phenom where it is trending upward as interest rates were on the rise. And then mid-year, we did get a drop in interest rates, and Bank of America responded in kind with a pullback. Here's another stock, another big winner for our MEM Edge report, but this is SVB Financial. And again, highlighting that concept in the beginning of the year as interest rates were on the rise. This, as part of that banking universe, was also on the rise. Now, you're not going to see every stock in a group rise and fall as that sector rotates. It's going to be very, very critical that within this concept, you are able to identify that leadership name, that winning stock that not only will go on to outperform the market, but also outperform its peers. SVB was one such stock. This is a company that I'm very familiar with. Years ago, when it was first founded, it was known as Silicon Valley Bank. They are a very strong company, many, many different areas of growth that helped propel this stock to, again, not only move in tandem with its peers, but to go on to outperform. The financial sector, again, going back historically, it's been one of the most sensitive to changes in interest rates. And this is particularly true of bank stocks. We are currently in a period in 2022 where interest rates are on the rise. However, bank stocks are not. And it has to do with the way that interest rates are currently positioned, with higher interest rates shorter term versus longer term. But again, that acute sensitivity to interest rates is very much in place, as it always has been historically. So let's move on. We did share with you in the beginning that technology was one of those top performers, up 34% for 2021. But we can see that it is an area that is also highly sensitive to interest rates. So going back, certainly this period I'm highlighting here is the end of May into September. Very healthy period here for technology stocks. And it was, again, that period when interest rates were declining. Interest rates affect technology and then other high growth areas as well, simply because their future earnings are going to be decreased as interest rates rise. This other period here, the technology sector did advance despite a rise in interest rates. And really, it was all about the ascent of those FANG, those heavyweight stocks. And we're going to get more into that as we move forward. I'm going to share with you those top components in these key sectors as another way to gauge rotation. So here we are with a sub-industry group within technology, and this is software stocks. The ticker is IGV. Quite simply, again, as interest rates rise, you will see these tech stocks falter. Here we are during a period when interest rates were declining, and this was another healthy period for these tech names from that June into September period. So let's go ahead and move forward. I'm going to share with you Adobe, another winner for us. As interest rates were declining, Adobe not only outperformed, it was a major component of the software sector, but we did have that other characteristic that I talked about in the beginning, and that is earnings. Adobe came out with 24% year-over-year earnings growth, and in response, the stock had a beautiful base breakout, which compelled us to add it to our list. So again, several factors here that are really moving as far as sector rotation, money flows in and out of various different industry groups. And then again, you want to make sure that you are selecting that winner, that outperformer. Adobe far outpaced IGV, which is its sector, far outpaced its peers for many reasons. One I mentioned is that growth prospect being the driver for that stock to outperform. Here we are with a daily price chart of Apple from last year. Again, quite simply, the fact that the stock deteriorated as interest rates were on the rise. And then as interest rates declined, we did get this nice uptick here. Again, certainly other factors with Apple relating to their iPhone and other product demand. Supply chain issues were being worked out. So there certainly are other backdrops, but again, that primary backdrop is going to be factors such as interest rates, money supply, and also monetary policy factors as well. So let's go move on from here and take a look at the healthcare sector. Another top performer, again, from January into December. And what I am pointing out to you here is utilizing the chart as yet another way for you to spot this sector rotation. We can see this nice base formation here, and then a breakout, this generally pushing healthcare, XLV is the ticker symbol, into a nice uptrend here into third quarter of 2021. So here's another stock from that MEM Edge report. This is Waters Group, WAT was the stock. We did add it to that suggested holdings list for two factors. One is that the backdrop, the sector XLV healthcare sector was pushed into an uptrend. And then once you see that, from here, this is where you want to put your shirt sleeve up and really dive in, because again, you want to make sure that you are getting that big outperformers. WAT was just that as it related to the healthcare sector. Another big winner for us, West Pharmaceuticals, WST, and we did add that when that XLV sector turned positive. And again, it did go on to far outpace the broader markets. I did want to mention it this time, and I'll mention it again. I have a webinar coming up Wednesday, September, I'm sorry, Wednesday, April 13th. And it's going to be talking about some of these concepts as well as others. But primary purpose for that webinar is to introduce you to a mentorship that I will be offering later in the month, so that not only will it cover a little bit will be sector rotation, but a lot of it is going to be sharing with you how you can uncover and get in front of these really big winners, these outperformers. So I urge you on the 13th to check out that webinar so that you can get more informed about this once in a lifetime mentorship that will be taking place. It's an 8-part course. Actually, more than a course, a lot more. There'll be live trading sessions and a lot more. So tune in, you'll find out more. But I did want to talk to you as well about the fact that big tech and certainly growth stocks, I did mention this, that they are going to be more sensitive to higher interest rates. And the reason for that is a lot of these high growth stocks have what are called high valuations. They have high multiples, and their future growth and cash flow will be negatively impacted in a rising interest rate environment. So you do want to be aware of that. So let's take a closer look at exactly what is the sector layouts. And we did talk about what drives price action. We're going to get a little bit more into that right now. So here we are with the S&P 500 sectors, and I'm going to share with you those 11 underlying sectors that are in the S&P 500. First up is information technology, and it accounts for a whopping 28% of the entire S&P 500. And this is important to know if you're trying to gauge whether the broader markets are in an uptrend or not. Take into account this heavy weighting. Healthcare is next up, and it is less than half of information technology. It accounts for 13% of the S&P 500. Consumer discretionary also in that 13% range. Financials amount for 11%. And this is a real switch, certainly over the last 20 years. Financials at one time were up here at the forefront, but as technology continues to expand with their innovation and new companies coming to public, this group is very much up here in the forefront as it relates to weightings. Communication services, this is going to be internet related stocks, 10.8%, industrials 8, consumer staples, energy, real estate, and materials. So what I am pointing out to you here is this weighting this year in particular. And then last year, we talked about the fact that energy was the top performer, but really it only accounts for 3% of the broader markets. So despite that outperformance, you're not necessarily going to see the broader markets impacted by that. Now, I do have these sectors color coded, and the reason is these red highlighted sectors are going to be a bit more volatile. They do have stocks among them that are higher growth and more responsive to investor sentiment, and then also earnings and other factors. Healthcare is green. It's a bit more, also has a growthier aspect to it, but it is part of the defensive areas, and it will not be quite as volatile as these red highlighted areas. And then in blue, you're more staid, what I call lower beta, certainly consumer staples and REIT stocks that are also great areas that can fare well during periods of market volatility. And then, of course, utilities, we cannot leave that out, 2.4%. And these areas, we'll get more into that as to where they stand now in the current market environment. So let's move on. We're taking a look here, a current chart of the technology sector, XLK. I talked about this being one of the heaviest weightings. So with this weekly chart, I did want to share with you generally how much this sector has been in an uptrend. But of course, last year we talked about that volatility that was inherent, and then entering into 2022, a very sharp sell-off among the technology sector. So with this weekly chart, I have what's called a 10-week or a 50-day simple moving average. And then this blue line is a 40-week or 200-day simple moving average. And they're both very powerful in the way of letting you know, is that sector finding support at these moving averages or deteriorating further? And we did see the tech sector break this key longer term 200-day simple moving average, historically going back to this 2018 and 2020 period. Those are both periods of a bear market. And we did, in fact, the NASDAQ did enter into a bear market in 2022. So we can see the significance here of technology as it relates to that broader market. Also, you want to use historical precedents to tell us when the sector may be turning. But let's take a look here at the top 10 holdings within this XLK sector. And this is going to be another piece of the puzzle as it relates to sector rotation, because these heavier weighted names will have an impact. So take a look. Apple, 21% of that technology sector. Microsoft, 20%. So these two alone account for a 42% weighting with XLK. So when you see this sector rotation, you can keep that in the back of your mind. I talked about that move into those FANG stocks at the end of 2021, and you can see the significance when you can see this heavy weighting. So from there, we can look at some other semiconductor stock, NVIDIA 5%, and so on down the line as it relates to this weighting. From here, I'm going to share with you also within technology, in addition to those heavy weighted stocks, it's also important for these various sectors to have a really good feel for those sub-industry groupings that make up a given sector. So within technology, software is a very heavy weight. There are over 350, actually over 340 stocks, 347 to be exact, that are in this software sub-industry grouping. So you can see how that can have the impact that it does. When software stocks move, so too does the technology, at least in some cases, grouping. IT services, 25%. And then technology, hardware, storage, and peripherals. A lot of this is going to be Apple's a heavyweight among here. And then semiconductors, another heavy weighting within the technology sub-industry grouping. Something to know when you are looking to uncover rotation, be aware of those sub-industry groupings. So let's move on. We're taking a look at the consumer discretionary sector. XLY is the ticker symbol. Again, a current weekly chart. And we can see that this, in line with other growth stocks, peaked in price at the end of 2021 and is in the throes of attempting to reverse this rather steep downtrend. Again, those moving averages here to guide you whether that group is in an uptrend or not. And at this time, the longer term prognosis is not quite positive. But again, let's take a quick look here at those top holdings in the consumer discretionary sector. And straight up here is Amazon and Tesla up here in the forefront. That is a 38 or 36% weighting for XLY. So oftentimes with these stocks, so too will the sector go. Home Depot, very surprising, with an 8.7% weighting, and then so on down the line, so that you can have a sense that not only is it retailers, Home Depot, Nike, McDonald's, and Lowe's are a big part. Also, Tesla is, and Amazon has a very large technology component to it. However, it is a key component of XLY. So from here, we can take a look at a different sector. This is XLC, communication services. And again, I talked about that being internet related. much steeper drop here with this particular sub-industry grouping, and it is much earlier in its attempt to reverse this downtrend. So from here, I'm going to share with you those top weightings, this descent and more early attempt to reverse will make sense. Take a look. Facebook is a 24% component of this sector. And for those of you that follow the markets closely, you may know that Facebook has fallen out of bed, for lack of better wording, but it has had a very tough period here of late. And then Google up here in the forefront. So we have 45% of this sector being moved by these very large components. Netflix up here at the forefront as well, and Disney and some other well-known names. So from here, I did want to just take a minute here and talk about where the markets are now. This is being recorded in the first week of April 2022, but more to the point is how you can use these simple moving averages to guide your decision as it relates to the broader markets. And this is something I do each and every week with my MEM Edge show on Fridays here at StockCharts.com. And I use not only these moving averages, but I also want to pay attention to these outside momentum indicators. Are they in a positive position? And we can see that the S&P 500 did break below this, back below this key 200-day simple moving average. So at this juncture, we are in a very volatile period, back in a very volatile period, and very tenuous. We're going to want to make sure that we can find support above this red 50-day simple moving average. So stay tuned for the broader markets, and we'll be on top of it as it relates to where the markets are, because in addition to paying attention to which sectors are in favor, it is very critical that the broader market backdrop is in an uptrend before you put money to work. Now, there have been exceptions, certainly this year, despite this steep decline, and I will get into that as we move on here, because there are going to be sectors in a, whether it's a corrective phase or a bear market, that are going to see flows into that area. So you will want to be aware of that. Here we are with a weekly price chart of the S&P 500, and I'm sharing this with you because it encapsulates the last three bear market periods. And this is how you can use history as your guide, not only for the broader markets, but certainly for various sectors and sub-industry groupings. And I'm just highlighting here the characteristics of the S&P 500 on a weekly chart as it was coming out of these bear markets relative to where we are now. And certainly going into this week, we were in the throes and much more constructively reversing this downtrend with the same characteristics coming out of each of these prior bear markets. However, again, something that we are going to be very closely watching. You can trial my MEM Edge report for 4 weeks and stay on top of these markets. There's a link below. So let's take a look at sector rotation and one of the drivers, and there is a concept I can call it. It's called business cycle that influences sector rotation. So in essence, are we in a period of what's called full recession? That's defined as 2 successive quarters of growth that is declining, GDP declining. And then are we in an early recovery, full recovery, or a potential early recession? And that in turn will not only drive price market action, but it will drive money flows into these various sectors. And this is from StockCharts.com. You can read further about this sector rotation and using that business cycle concept to as another way to guide you as these as money flows in and out of these different sectors. So let's take a look at where we may be currently. There is strong evidence. I did only briefly talk about this full recession, early recovery, and how that in turn translates into where the markets are as it relates to bull versus bear and so forth. So at this point, we are what can be termed as a late cycle phase. And that has everything to do with business development, with growth concepts, global growth, not only GDP, but also corporate growth. And then also, as the economy matures, we're coming out of that 2020 pandemic bear market. What will occur is that energy and material sectors will do well. What takes place during this late cycle phase is inflationary pressures build, and late cycle economic expansion does help maintain solid demand, but it is going to be primarily for these energy and material sectors. Also, defensive sectors perform well during a late cycle phase, and that is going to be healthcare, consumer staples, and utilities. So currently, this is what we are looking at, and in turn, you will want to focus on those sectors. Also, technology and consumer discretionary stocks do tend to lag the most during this late cycle phase. So let's take a look. This is a little bit of a busy chart here, but this is a current chart of XLV, that energy sector. And I shared with you the fact that the NASDAQ had gone into a bear market. Certainly the S&P 500 was in a correction at the beginning of the year, but let's take a look at XLE at the beginning of January. This is January 4th. I know it precisely because I put out an alert report with my MEM Edge Report alerting subscribers that the energy sector had turned positive. And this was all about higher interest rates. This dialogue here, or text, is directly from my MEM Edge Report on that day. And I talked about the S&P 500 closed flat as rotation within the markets pushed both energy and financial stocks higher, while technology stocks sold off. The move was in response to a continued uptick in interest rates in anticipation of the Federal Reserve's reduced bond buying in order to fight inflation. And that has, in fact, played out. But this is from my January 4th alert report. And we can see the clear-cut impact as energy has gone on to greatly outperform an otherwise dismal market. So here is a pick again on that January 4th. I added 3 energy stocks. OXY was one of them. And again, I talked about that importance of getting that big winner. OXY is up 70% since we added it to our report. A lot of dynamics, a lot of reasons for that as it relates to the outlook, the earnings prospects, the yield growth, and other factors. So let's also talk about where we are. There is talk that we may be in for what's called stagflation, and stagflation is an economic phenomenon, if you will, that occurs when inflation rises but economic growth slows. So the last time that we did see this stagflation backdrop was in the 1970s into the early 1980s. And at that time, oil prices skyrocketed as inflation reached double digits. And then also during that 1970 into early 80s, we did see unemployment soar to 10.8%, and the S&P 500 lost quite a bit. So as it relates to currently, inflation is elevated. Depending on what metric you use, it's above 7% at a 40-year high, but it's not at double digits. Unemployment is in very good standing. In fact, we are at pre-pandemic levels. However, we have seen oil prices skyrocket into triple-digit levels per barrel. So a bit mixed, but let's take this a step further. Actually, I can talk about that as far as areas of the market that do perform well during a period of stagflation. And generally, it is energy stocks, and raw materials. That's going to be gold, iron, steel, and so forth, in line with that late cycle phase that we talked about with the economy. So last up here, I am sharing with you a 2-month daily price chart view of the 11 sectors in the S&P 500. This is a current view. I did sort these sectors by relative strength, that relative outperformance. And what we are looking at is very much in line with what we had been discussing, again, as it relates to late economic cycle and defensive areas faring better. You can see up here at the forefront, utility, REIT, staples, and healthcare. And these are all areas, again, that are defensive, but they do also offer higher yields with the underlying stocks in those industry groupings. But this is an exercise that you can do as well as it relates to staying in front of sector rotation. And as we move forward, we want to be aware of those areas that are underperforming. I talked about technology. That is an area during a rising rate environment that does not fare well. Also, high growth consumer discretionary down here in this lower quartile, conceivably or actually underperforming. And then financials. I did mention the phenomenon that's taking place with those bank stocks and industrials. This is all about transportation stocks that have pulled back very sharply in the face of rising energy prices, certainly some of the trucking and other areas. So again, taking a look at sector rotation, really trying to convey, if I haven't already, the importance of not only selecting that right sector as far as your overweighting or underweighting within your portfolio, but the importance of then selecting the top, what I call leadership name within that sector. And that is, again, what I will be reviewing in my webinar next Wednesday on April 13th, 7 p.m. Central Time. The link to sign up for that is below. And then even more importantly, with that, I will be talking about my mentorship, and it's going to be all about helping you uncover a rule-based system that is very simple, but very powerful as it relates to helping you uncover not only where to be focused as far as uncovering that next big winning stock. There will be quite a bit more in the way of talking about portfolio weightings and again talked about live trading. So it's pretty exciting. I have not done this before, and I'm not sure I will do it again. So it will be what I'm terming a once in a lifetime opportunity to really get into precisely how you can uncover that big winning stock to go on to outperform the broader markets. I hope you enjoyed today's presentation. I look forward to seeing you next Wednesday at my webinar and at my mentorship later this month.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.